welcome along to the Property Academy podcast. I'm your host, Ian McKnight. And today on the show, we've got another case study Sunday, and it's a banger because we're going to do something that we've never done before. First of all, I'm going to let Andrew be the case study Sunday today, or lead it, in terms of telling us about one of the investors he's been working with. But on top of that, we are, for you guys watching on the YouTube, we're going to open up and show you our My Wealth Plan software, the exact software.
Is this the first time we've done that?
It is the first time we've ever shown our actual software that we use to plan with investors who want to invest in property.
And you get the return on investment calculator working as well.
100%. Now, for all you guys listening on the podcast, we're still going to describe everything that we are seeing, and it's still going to work as a podcast as you guys like it. Let's rip into it. Tell us about who the investors were in this situation, Andrew. What did they want to achieve?
Okay.
Who were they?
Okay, so these investors came in to see me this week, and we've talked through kind of where they're tracking at the moment. So these guys are podcast fans, I believe, and they've been using somewhat of a My Wealth Plan. This is the newer version of My Wealth Plan. So I promised them I'd enter in all their details and come up with how they're tracking now. They've taken the advice that we've given them and gone out and bought 2 rental properties to add to their one that they already owned. And the one that they owned at the moment, that was previously an owner-occupied, then it became an investment property. And so now they've got 3, one of which is just about finished.
And Brian and Deirdre, it's so nice that you're letting us tell the world your numbers.
Brian and Deirdre, you love to choose such Kiwi names.
Yeah, I thought they were Coronation Street names.
Okay, yeah,
Sorry
probably.
to the Brian and Deirdres out there. So what did they actually want to achieve through property? What was their ambition?
Okay, so their goal, as you'll see on the screen if you're watching this on YouTube, is $200,000 a year. Now, I'm just going to take you back a screen. So there are 3 options we have when investors come to use us, and they're using My Wealth Plan. Build wealth. So if you've got no idea what you want to have it for, you just want to have $2 million by the time you're 40. Retire comfortably, so you want to have a certain amount of money that you can sell all your assets, put it in a bank account, dwindle it down until you die.
That's the nest egg strategy.
That's the nest egg. And then the generate passive income is the one we often call the golden goose. That's the one where you're going to sell down your growth assets, have high yielding assets, unencumbered, so no debt on them, and live off the income forever. That's the strategy that we're going to use for these guys because they're just young, 33 and 35 from memory. So they're really kind of in the early stages of their investing career. So they've got heaps of time. Now, what we're doing for them is we're working on basically replacing their income. Now, at the moment, they're on about a combined income of about $229,000 a year, I think it is. But of course, they pay tax on this. You'll still pay tax on this money, so we have to factor that in. But they're paying Kiwisaver and they're paying a personal mortgage at the moment. So, if they get to 20 years from now and they've got no mortgage and they're not putting into Kiwisaver, they should arguably have a better lifestyle than what they've got now. And I've put 20 years in there at the moment, but that's actually shorter than when we first did the My Wealth Plan.
And just for everybody listening, when he says I put 20 years in there, he means and they want this passive income to start in 20 years' time. So Brian and Deirdre's goal, $200K a year in passive income in today's money, but starting in 20 years' time. So they've got that long to build those assets down.
All right, so they're Kiwisaver, so they've got $49,000 in there at the moment, $227,000 combined income, putting 3% in and getting 3% matched. Now, the Auckland property that they already own, so it's worth $1 million right now. It's got $595,000 worth of debt on it today. It's principal and interest, but they're just about to turn that on to interest only. And we'll say because it's Auckland, it's going to get a 6% capital growth rate. And then they've got those 2 Christchurch properties that they've since bought. So they've got one which was originally bought for $659,000, but it's worth $830 now, and debt of $659,000, interest only. And then their second Christchurch property that completes in the next couple of months, they paid $710, so that's going to be their mortgage on that, and it's worth $825 on a bad day now.
And just to quickly recap on that, because that was quite quick, what have they got? They've got 3 properties, and they've got pretty modest Kiwisaver, $50K in Kiwisaver, and I've got 3 properties already. Now, what I want you to tell me, Andrew, is with those, I suppose, 4 investments in place, how close are they right now? If they do nothing else, how close are they to achieving their goal?
So they're $171,000 today's dollars of the $200,000 of the future dollars. So they only need another $750,000. So they're pretty much there. They've done really, really well. And, if we pushed out the years, so for anyone watching on YouTube, I will just show you now, if we push that out a couple of years, if people have got time on their side and say, look, I can cope working another couple of years, you close that gap pretty quickly.
Okay, so if they do nothing else, they're going to have 170K in passive income, at least by these numbers. But that's still not their entire goal. They've still got to get another $750 million worth of assets over the next 20 years in order to hit the goal of 200K. So what's the strategy here?
Okay, so now what I've done is I've worked in the minimum amount of investment in Auckland, so a 6% capital growth rate, that could achieve that. Now, the purchase price today, borrowing 100%, would only need to be $500,000. Now, I know what you're thinking, Ed. What can you buy for $500,000 in Auckland?
Well, certainly, you could probably buy maybe a hotel room, a small apartment.
Leasehold apartment or something.
But the issue there is you're not going to get a 6% capital growth rate on what is effectively a yield-based investment.
Exactly. Now, this is where it gets slightly more complex with these guys. So they're tapped out from a servicing perspective. They can't borrow any more money from the bank anyway. So the reason I've done this is I've worked on, okay, maybe there's a better structure in what they're doing at the moment. Okay, so this is where it gets interesting. So what I've actually looked at for these guys is whether or not their existing Auckland property is the right property for an investment long term. So it may have served its purpose now. So it's $1 million property today, but it's deemed as an existing property. Why is that important? Well, it's going to affect the cash flow. So the $595 debt that they've got on that at the moment is not going to be tax deductible once the phase out is complete. So if we look at what the actual numbers look like on this, you'll see that you are these investors are topping it up, a couple of $100 a week, and it will drop down over time as interest rates get lower, but again, it might not be the best use of money given that they've got 40% equity in that. So what I've thought is, well, that's probably affecting their servicing. So if they sold that property and redistributes the equity across two properties worth, say, $750 each, that gets them up another $500,000 worth of investment in Auckland. So two new Auckland properties worth $750 each, but with $200K worth of equity in them. Same rules, same interest rates, but with $600 a week per unit, so better yield across them. Then what you'll see is the return on investment, you're talking about 411% per property compared to 230% roughly. And the contribution for the new properties is $78 per property for 3 years, so a little bit higher than the 105 on average, but that was for 9 years for the existing property.
Okay, and just to put that into context and say it another way, if they held onto that Auckland property, they would get a return of an extra about $2.30 per dollar that they were investing into that property. Now, if they invested in these Auckland properties instead, they'd get $4.11 back for every dollar invested into that property. So about 80% more just by changing where they are putting it, selling that property and purchasing two new builds in that instance.
Yes. Now, in this case, one of the other little tricks to think about is actually they've still got personal debt, so they probably won't actually use that $400,000 that they'd get if they sold that existing Auckland rental to put into the rental properties because it's tax inefficient. They'll use that $400,000 to pay down their personal debt, so that'll free up the cash flow on that side of the ledger. That gives them the money to top up the Auckland properties. Okay,
so they needed to make $750 million in today's money over a 20-year period. If they follow this, what's it going to do for them?
They will be retired by the time they're 55. One of the important things when you are building out a wealth plan is not only to look at what you're adding on, but what you already have. That's one of the differences here because these guys have hit a wall in their investing ability because the bank's no longer going to give them money. So then at that case, you need to look at, well, are my properties that I've got at the moment the best possible properties? Now, when they bought their two Canterbury properties, they bought at a really good time. The values have gone up, the rents have gone up, and even though interest rates have gone up, those are pretty much cash flow positive. They don't have to put any money into them pretty much in the next couple of years. So that gives them the ability to, again, free up that equity in their Auckland property and create a bit more servicing ability to go on and borrow more money. Now, there was one more trick with this one, which we'll just talk about. Hopefully it doesn't make it too complicated for you listeners. The Auckland property is actually subject to Brightline. So what they're probably going to do is not sell that property. Now, it just so happens that their house that they live in is on the same street as their rental property. So they're probably going to sell their owner-occupied property, move into their rental property and pay off that.
Oh, that's quite smart, actually. Yeah, because their current home is not subject to Brightline.
Correct, because it's owner-occupied.
Because what would they have to, how much tax would they have to pay? It'd be obscene.
It worked out to be about $75,000 once we took off for agents' fees and stuff like that. Just not worth it.
Well, it's not just 75K, it's that they'd also have to pay agents' fees, which might be another 40K, for instance. So they could be, at least 110K down if they decided to sell.
So that's where we thought, okay, well, this is a better way of doing it. The other great part about that is their owner-occupied house is worth more than the investment property, so they'll actually end up in a better position by selling that one.
And you've said that they're going to purchase 2 750K townhouses in Auckland, new builds. What can you get for 750 in today's market?
Look, that was just example numbers, and it might be that they end up spending kind of 900,000 on one and a little bit less on the other potentially. We've got to play around with that. For now, this is about the concept. They still have to talk to their broker about whether or not all of this is possible from a lending perspective with the change in circumstances. But if you were just spending 750,000, you'd get a 2-bedroom townhouse in somewhere like Glen Eden, or you maybe get to Avondale.
And I think what's important here is there are a couple of quite good little tricks, if I can say this. Selling the one existing to buy 2 new builds to get that extra $500,000 of assets under the control. Skirting around the Brightline test.
Not skirting around it. That sounds like you're doing something wrong.
Well, I was about to say avoiding, but I know that that's a no-go word as well.
They're just selling the right property that's not subject to Brightline. It's like if you had 2 rentals and one was subject to Brightline and the other wasn't.
Yeah, but they're making a decision so as not to have to pay the Brightline in this instance, not to trigger it. And they're going to do it by selling their own house, which I think is quite intelligent.
Which, yes, it makes it a bit more of an inconvenience for them because now they have to move rather than the tenants having to move.
Yeah, but do you know what's an inconvenience? Not having
$75,000.
Yeah, but also not having the extra $30,000 a year passive income in your retirement. That's an inconvenience too.
And just one thing, just in case anyone was wondering why I didn't use superannuation in this instance, the government superannuation. Well, these guys are going to be retiring long before the superannuation age would kick in, and they're so far out that I just wouldn't want to rely on that.
And I think what's really powerful, and one of the things that I'm quite excited about revealing this, I suppose, for the first time, showing it, and of course everybody listening on the podcast can go, watch all of this on YouTube as well to see the visuals, is that there is a very definitive process for how you go about goal setting when you're planning out your financial life. You've got to identify what's your goal, how many assets do you need, and then you've got to figure out, well, how on track am I for this? And do you know what's interesting about this? These guys are actually more on track than many of the investors would usually work with. And the reason is they've already got 3 rental properties within their plan. But if you're starting out today and you've got nothing in your plan at the moment, that gap between your ambitions and what you want to achieve and where you're currently on track for, there'd likely be quite a gap. If we took out all of those properties or just leave one in,
well, based on their Auckland property that they had when they first heard about Opus and the Kiwisaver that they had, they were only $90,000 on the way to that $200,000 goal.
So, 45% of the way there was actually still not too bad. But the key thing here is you've got to go through a process of identifying what's your goal, how on track are you for it, and then if there is some gap, if you're not on track to hit that goal, you've got to do something about it. And it could be property, it could be shares, it could be anything. But I'm assuming if you listen to this podcast, you're probably keen on property as well. Right, we're going to wrap it up there, but please don't forget to rate, review, and subscribe to the Property Academy podcast. It really does help us get the message out to more people. And hey, if you want to use this software yourself and go through it with a financial advisor, then you might like to come in for a portfolio planning session. Completely complimentary, easy way to sign up. Whip out your phone, send a text to 5522. Text us the word plan, and we'll give you a buzz, see if it's the right fit for you. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.